Good morning from the New York Stock Exchange, where the city's financial pulse is just beginning to quicken. As the sun rises over lower Manhattan, traders and analysts are preparing for another day of market action, with all eyes on the opening bell and the first signs of momentum. Today is Tuesday, August 5th, 2025, and the mood on Wall Street is one of cautious optimism. After a period of volatility and uncertainty, investors are hoping for a steadier session. The market opens with a sense of anticipation as participants weigh the latest economic data, corporate earnings, and global headlines that could sway sentiment. Stock futures are pointing slightly higher this morning, suggesting that confidence is slowly returning after yesterday's impressive rally. The green arrows on the screens are a welcome sight for many, hinting that buyers are stepping back in, though with a measured approach. S&P 500 futures are up about 0.1% to 0.2%, a modest but positive move that reflects a market still finding its footing. Investors are watching closely to see if this upward momentum can be sustained throughout the day. Meanwhile, the Nasdaq 100 futures are showing a stronger 0.3% gain, with technology stocks once again leading the way. The tech sector's resilience continues to be a bright spot, as companies in this space report robust earnings and maintain investor confidence. The Dowjonesindustrialaverage, however, remains flat in early trading. This reflects ongoing concerns about the broader economy, including persistent worries over inflation, interest rates, and the impact of global trade tensions. Yesterday's rebound was a much-needed boost for the markets, snapping a four-day losing streak. The S&P 500 surged by 1.5%, signaling renewed buying interest and a shift in sentiment after several sessions of declines. The Dow also saw a significant jump, climbing 585 points by the close. This sharp move higher brought a sense of relief to investors who had been rattled by recent market swings. As the new trading day begins, investors are carefully balancing upbeat corporate earnings reports with ongoing policy debates and economic uncertainties. The market remains sensitive to any news that could shift the outlook, from central bank decisions to geopolitical developments. This morning's modest gains are a welcome sign, but the mood is still one of watchful waiting. Wall Street is treading carefully, looking for confirmation that yesterday's rally wasn't just a temporary bounce, but the start of a more sustained recovery. To truly grasp why the stock market moves the way it does, you need to look beneath the surface and focus on what drives individual stocks: corporate earnings. These numbers are the heartbeat of the market, providing a window into a company's health and future prospects. Every 3 months, companies open their books to the public, releasing quarterly earnings reports. These documents reveal crucial details: how much money the company made, how much it spent, and what's left as profit. But it's not just about the numbers. These reports also include management's commentary on what went well, what didn't, and what they expect in the months ahead. Investors and analysts eagerly compare these results to their expectations. If a company beats the forecasts, its stock price often jumps as confidence surges. But if the numbers fall short, even by a small margin, the reaction can be swift and severe. Stocks can tumble in a matter of minutes. Yet the story doesn't end with past performance. The guidance companies provide for upcoming quarters is just as critical. Even after a strong quarter, a cautious or negative outlook can send shares lower, as investors worry about future growth. Conversely, an optimistic forecast can lift a stock, even if recent results were only average. This period, known as earnings season, acts as a reality check for the entire market. It forces investors to reassess what a company is truly worth based on hard evidence rather than speculation or hype. Portfolios are adjusted, and investment strategies are reevaluated in light of the latest data. Ultimately, these reports draw a clear line between winners and losers. Companies that consistently deliver strong results and positive outlooks attract more investment, while those that disappoint may see their stock prices fall and investor confidence wane. For anyone investing in the stock market, quarterly disclosures aren't just routine paperwork. They're essential reading. They offer insights that can't be found anywhere else, helping investors make informed decisions. In the end, these reports form the foundation for deciding whether a stock is a smart buy, a hold, or a risky bet to avoid. Understanding them is key to navigating the ever-changing world of investing. This earnings season, three companies illustrate how reports drive market winners and losers. Palantir soared after a stellar report, while Caterpillar and Hims & Hers Health stumbled. Palantir's strong execution and growth narrative sent its stock higher. Caterpillar missed expectations, raising concerns about the global economy. Hims & Hers missed revenue targets, gave weak guidance, and ended a key partnership, sending its stock tumbling. These stories show the market isn't a monolith. Individual performance determines fate. Today, these companies are the headlines moving the market. Palantir Technologies is today's standout success. Before the market opened, its shares jumped 7% on a blowout earnings report. For the first time, Palantir's quarterly revenue topped $1 billion, a major milestone. The company also secured a massive $10 billion contract with the U.S. Army. This deal provides long-term revenue visibility and validates Palantir's growth strategy. Beating expectations and locking in future business is a recipe for a stock rally. Investors see both current strength and a clear path forward. Palantir's surge is a textbook case of the market rewarding strong results and vision. On the flip side, not every company can deliver the results Wall Street hopes for. This morning, both Caterpillar and Hims & Hers Health found themselves in the spotlight for all the wrong reasons, as their latest earnings reports fell short of expectations. The mood on the trading floor quickly shifted from optimism to concern, with investors and analysts closely watching every move. Caterpillar's earnings missed forecasts, sending shares down over 3%. For a company often seen as a bellwether for global industry, this stumble sent ripples through the market. Investors were quick to react, questioning whether this was a one-off event or a sign of deeper challenges ahead. The company also warned of a $1.5 billion tariff headwind, highlighting the real cost of ongoing trade disputes. These tariffs, especially those involving major economies like the US and China, can have a significant impact on manufacturing giants like Caterpillar, affecting everything from supply chains to profit margins. Meanwhile, Hims & Hers Health faced its own set of challenges. The company's stock dropped more than 10% after it missed revenue targets, issued weak guidance for the coming quarters, and announced the end of a key partnership. For a fast-growing healthcare startup, these setbacks raised questions about its future growth and ability to compete in a crowded market. The market's reaction was swift and severe, a double-digit plunge for Hims. Investors wasted no time in reassessing their positions, and the sell-off reflected a sudden loss of confidence in the company's near-term prospects. These examples showed just how quickly sentiment can turn when companies disappoint. In today's fast-paced markets, even a small miss can trigger outsized reactions, as traders and investors scramble to adjust their strategies. Investors don't hesitate to sell when promises aren't met. The pressure to deliver quarter after quarter is relentless, and any sign of weakness can lead to a rapid exodus from a company's stock. Whether it's external headwinds like tariffs or internal missteps such as missed targets, the market punishes underperformance without mercy. The consequences can be immediate and far-reaching, affecting not just share prices, but also company morale and future strategy. The lesson is clear. In earnings season, bad news travels fast, and the market's memory is short. Companies must be prepared for swift judgment, as investors look for any sign that reality isn't living up to expectations. Just as markets steadied, trade policy jitters returned. President Trump announced plans for new tariffs on semiconductors and pharmaceuticals, with chip tariffs coming soon and pharma tariffs possibly reaching 250%. These comments immediately cooled market enthusiasm, trimming early gains. Tariffs mean higher costs for companies and more uncertainty for investors. The president also threatened new tariffs on India and reminded markets of a looming trade deadline. Recent tariffs on Taiwan and threats to Switzerland add to the global uncertainty. Trade policy can shift markets instantly, overriding even strong earnings. Investors are encouraged by corporate results but remain wary of unpredictable policy moves. This morning's caution follows a wild week on Wall Street. Last week, all major indexes fell sharply, with the Dow posting its worst week since April. A weak jobs report and sudden tariff announcements fueled the sell-off. Fears of economic slowdown and trade wars dominated headlines. But Monday brought a sharp reversal. Investors shifted focus to strong corporate earnings. The S&P 500 surged 1.5%, the Dow jumped 585 points, and the Nasdaq rose 2%. The rebound reset the narrative, moving from recession fears to earnings optimism. Today's gains are built on that resilience, but memories of last week keep optimism in check. Stepping back, this earnings season has been surprisingly strong. Despite fears of slowdown and tariffs, most U.S. companies are beating expectations. FactSet reports 81% of S&P 500 companies have topped earnings per share forecasts, well above average. The S&P 500 is on pace for 10.3% year-over-year earnings growth, a robust result in any climate. This strength helps the market absorb negative news and bounce back quickly. Investors now await key reports from Snap, AMD, Rivian, McDonald's, and Disney. Each will offer fresh insight into tech, consumer spending, and the broader economy. The positive trend so far gives the market a strong tailwind as earnings season continues. The market's next move depends on both corporate results and government policy. Strong earnings build optimism, but policy surprises can shake that foundation. President Trump's tariff threats and ongoing trade talks add unpredictable risk. Investors must watch both earnings reports and Washington headlines. Upcoming results from Snap, AMD, and Rivian will be key, but so will any new policy announcements. The market stands at a crossroads: strong corporate performance on one side, policy risks on the other. Navigating this landscape means staying alert to both Wall Street's numbers and Washington's moves.